Hello everyone and welcome to your Glassnode video report for week 34, 2023. So we had a pretty violent end to a very, very quiet couple of weeks, even months. What we covered really over the last two episodes, which if you haven't seen those, weeks 32 and 33, I would actually strongly recommend going back and viewing those, even though they're a little bit in the past now. It is important to just see how this whole week played out. And what we're going to do today is really look at this sell-off that took us down, well, briefly below 25,000, but we're currently hovering at around 26. But those previous 2 weeks really set up from both a derivatives position, an on-chain position, and just a simple price performance position. All three of those were suggesting two things: that the market had gone to sleep in a very uncharacteristic manner, that volatility was massively underpriced, particularly in derivatives markets. And last week, we covered the concept of a top-heavy market and what that actually means in a spot sense. And what we've seen this week is essentially the playing out of those three factors, where Bitcoin is unlikely to stay non-volatile for very long. Derivatives markets were just simply not prepared for it, and we're going to look at today how dramatic that was. And then we're going to refocus back in on the spot and the on-chain market to really show you where there's some serious edge in all of this. So we had a pretty dramatic week, right? Very rarely do we see markets go to sleep like this. Range contraction, which is what we saw over the last couple of months, leads to range expansion. The challenge is always which direction is it going to go? And that is where we start looking at how is the market pricing things. And particularly, this is where I believe that on-chain really provides a very unique lens. You just don't have this level of insight in traditional finance. What the on-chain side of the equation was helping us understand is how many price-sensitive buyers in what we call a top-heavy market do we actually have? And we're going to really explore this concept in a great bit of detail today. I think it's a really important topic and one that we're going to really zoom in on and spend the back half of this session looking at. Now, there's two other things. We're also going to introduce this particular metric here, what we call the realized profit loss ratio momentum. It is a bit of a mouthful. It really does need a buzzword. So bonus points in the comment for anybody who has a cool name for this thing when we go through it. And one thing I also just want to flag before we get started: as of this Thursday, there'll be a very exciting project that myself and Dave Puel from ARK Invest have been working on for over 18 months. This is a fairly tremendous piece of work. And I'm really looking forward to bringing it live. So do stay tuned. There'll be videos and a live PDF and things that come out on Thursday. So do pay attention to your Glassnode emails if you're subscribed, and also to this channel and our Twitter feed. Really looking forward to bringing that through to you. But for now, let's jump right back into the action and get started with the analysis. Okay, so we're going to step through in a very similar manner, almost wrapping together. As I mentioned at the start, we did kind of the spot, the derivatives, and the on-chain over the last 2 weeks as the prelude to what happened this week. We're essentially going to do the same thing. We're going to start with our spot, with our price models. We're then going to move to derivatives, and then we'll close out with the spot, just to show you how all of these things have essentially played out. Now, the first thing we're going to start with is, and in the week on chain report, which again, you'll find the description to that always in the description below. We called the first section of the report technical damage, because in many ways, what we'll see, and we'll zoom in just a second, this model here is just simply 4 of Bitcoin's very long-term moving averages. The 110-day up here in pink. Some like to use the 128-day, but this is just one of these moving averages that just, for whatever reason, has this kind of relationship with Bitcoin. It just tends to, you can see during bull markets, tends to provide support. So we've got the 111-day, we've got the 1 yearly moving average, the 200-day, and the 200-week. And why do we use these? Well, quite frankly, because everybody else uses them. And the reality is that when a moving average or any technical indicator has many people looking and observing it, it tends to create a self-reinforcing function where that is, traders and investors react to it because people are going to react to it. One of these psychological games. And at the end of the day, technical analysis and on-chain analysis are doing the exact same thing, plotting human fear and greed against time. It's just how it gets plotted in the data. Now, in terms of technical damage, we have punched down below 3 of the 4 moving averages. And the next one, if memory serves, is down here. This is the 1 yearly. I think it's down here at 23,000. I don't have my notes with me at the moment, but I believe that the next stop is 23,000. So not the best thing, but you can see here there is most certainly some technical damage in the sense that it has broken down below those key support levels. So as a result, the bulls are most likely on the back foot. So that's kind of our first piece of information. And now we're going to link it with an on-chain kind of equivalent to this. And I believe it is useful to actually look at these in tandem. Here we have our long and short-term cost bases. The red one here is the short-term holders. Now, just for a bit of a sense of scale, short-term holders are essentially the people who are most active in the market, recently bought their coins. And if you want to kind of conceptualize what this means, if you've been in this market for, let's say, 2 years, 3 years, maybe even 2 cycles, what was your cost basis in 2021? What was your cost basis in 2019? Most people just can't remember back that far, right? These things tend to escape us. If I asked you what your cost basis is yesterday or last week, there's a much higher probability that you're aware of it and you're psychologically predisposed to react should price do something close to a recent buy. It's recency bias. This is essentially what we're looking at. Now, not only is the short-term holder cost basis, we have now sliced through it. It was at 28,400. Now that we've sliced through it, this is now telling us that a lot of people who bought recently are now underwater on their holdings. So we're going to step back and look at this. But if we just take both of these models, the technical analysts in the room who don't know anything about on-chain analysis, they are now looking at this and saying, well, the bulls are probably on the back foot. The on-chain analysts who are looking at exactly the same thing, human behaviors, just from a different angle, they are also saying, look, it looks like the bulls are now on the back foot. Historically, this model provides support because people want to buy their cost basis. We now have to look and see, do people actually want to sell their cost basis and get their money back? Do we see that shift in investor sentiment? And that would, to a technical analyst, look exactly the same as resistance being found on a moving average. And both will point fingers at each other and say, see, I was right. Now, sticking just with one last thing in terms of the overall price performance, I've got here the weekly price performance and the daily price performance. Now, what I also have in the blue is a mean plus 1 standard deviation. So we're basically looking for plus or minus 1 standard deviation moves, right? Negative in the red. Now, on a weekly basis, right, it was a nasty week, right? But we've had a lot of really nasty weeks. So in the grand scheme of things, the weekly performance was, I mean, it wasn't great, but it also, we've seen far, far worse. So just put that into a bit of perspective. On the daily basis, however, this is on a year-to-date view, this was the worst year-to-date. Let's actually just zoom back and see how far we have to go to find a previous day. FTX was the last time we had something that was pretty this nasty in a short period of time. So just to put things into a bit of perspective, it was a pretty meaningful sell-off, right? We sold off about $3,500 in very, very short order. And now what we're going to do is really understand the mechanics. What actually drove this particular sell side? Now, we're going to start with the options market. And that's what we talked about in week 32 in Volatility Crush. The core thesis of the Volatility Crush piece is we're looking these two metrics at the top here, implied volatility and delta skew. Now, implied volatility is it's part of the volatility premium that gets baked into options. Part of the probability, how likely is it that some far and away strike price is going to get hit? Now, just to summarize what we saw back then, Bitcoin has historically been within this kind of 60 to 100% implied volatility for the vast, man, this is the full history of our data. So essentially, since options have been trading, Bitcoin has been somewhere between 60 and 100%. Except for 2023, where we got down to half of that, between about 25 and 50%. Now, we were down at literally all-time lows as far back as the data goes in terms of implied volatility. At the exact same time, delta skew was hitting pretty much an all-time low. Now, for those who aren't familiar with options, what delta skew, a low value is essentially saying that put options, downside protection, right? People buying insurance in case the market goes lower, was the cheapest it's ever been relative to call options. People were preferring to speculate on the upside. Not many people were speculating on the downside or buying insurance for the downside. And the market was pricing in extremely low volatility. So therefore, the question becomes, well, what would happen in a max pain scenario where nobody is insured for the downside and they haven't priced in volatility and we go back to at least 2x back into our previous range? Well, that is precisely what happened. Delta skew explodes higher as people scramble to buy put options, and our volatility shot right back into our range. It doubled pretty much within a couple of hours. So it was kind of one of those things where it was just a very, very simple max pain type scenario. Nobody was positioned for downside, and lo and behold, that is essentially what the market decides to do. Now, I mean, options, and we covered this, I can't remember if it was week 32 or 33, but options in terms of overall open interest are now of a similar magnitude. Historically, futures dominated. Options were very small. We're now looking at a regime where options are not quite as big right now, but on a very, very similar magnitude, right? We're not talking about 10% anymore. We're talking about 70, 80, even 100+% of the futures market. Now, what you can see is that overall, for the last couple of weeks, and even including our sell-off, we have not really seen a big change in both put and call option open interest. It's actually been fairly stable. We didn't see any kind of major deleveraging or flush out or panic in the option space. We definitely saw an uptick in volume. It more than doubled during the event, but that's we typically see that, right? High volatility creates trade volume. This is fairly normal. So the big takeaway here is that, yeah, there's no question that options were certainly mispriced for the event that played out. But we didn't really see the cascade forced by the options market. We didn't see a bunch of people panic sell out and all the rest of it. Contrast that to our futures markets. This is where we saw a major leverage flush out. And in many ways, this feels like it's actually the catalyst overall. So what I've got here is the perpetual futures open interest. And you can see here's FTX, right? This is our lead up following 3 arrows blowing up. Luna, 3 arrows. Both of these were major deleveraging events. You can see the scale of futures open interest that was closed out. And we had this kind of gradual grind higher and higher and higher until we had a wipeout when FTX. Now, part of this wipeout was traders getting liquidated. Part of it was the exchange that actually had that open interest disappearing, right? So there's a few layers to this whole thing. But note that our open interest has been steadily climbing and climbing and climbing into the actual sell-off event itself. And then bang, a huge leverage wipeout. If memory serves, it was about $1.2 billion within just a short, about an hour or 2 hours. So a major, and you can see the scale of this, it is not quite FTX, but it's not far off it. It's of a similar scale in terms of leverage wipeout that we saw during Luna and 3 arrows. So we have a serious leverage wipeout, and the scale of this is just different to what we see in the options market. So in many ways, it kind of tells us that the futures markets in particular were heavily betting on a long trade, and the long liquidations tell us that they were indeed wrong. 230 million in just a handful of hours liquidated. It is essentially the large, in fact, there were more long liquidations than there was during FTX. Now it is I can't quite recall if this is actually because FTX liquidations just literally didn't happen because FTX didn't exist anymore. Hard to tell, but nevertheless, since most of these futures are traded on Binance, and that remains one of the largest exchanges for this, it is essentially the largest we've had in a long time. In fact, and just getting into that, the bulls are now on the back foot. This short squeeze, right? This red zone here, this short squeeze is actually what kicked off the 2023 rally, right? Generally speaking, these kind of trend shifts happen when there's some event where lots and lots of traders are offside and suddenly the market gets a burst of momentum in the other direction. Well, the short squeeze that we had back in January is the last thing that was even remotely close to this. So it does have the potential to be a trend shifting event. So again, we're below those moving averages, below those cost bases. We've got a nice big liquidation, which tells us it was largely a positioning type game, but it was also of a scale that's large enough to cause a bit of damage that can sometimes shift sentiment. Now, our funding rates did go into negative territory, albeit significantly less than what we've seen during previous sell-offs and certainly during FTX. So we did see that there was an incentive for those market makers to essentially go long and arbitrage the price, but it also tells us that it wasn't really the most nasty that we've seen in terms of futures liquidations. But when we do get negative funding rates, it really does mean that the futures price was getting sold down much more than spot, which again gives us an indication that a lot of this particular sell-off was mostly driven by futures markets. Just gives you a bit of a gauge there. Now, this is where we move on to the really fun stuff. This is the on-chain side of the equation. Now, last week, we covered the concept of a top-heavy market. Let me just rebuild what I mean by this. So what happens during all market cycles, both to the upside and the downside, is that coins change hands. Now, let's look at this on a big picture view. In a bull market, what happens? Lots and lots of old holders, long-term holders, they sell their coins, they take profits, but someone bought those coins. And what tends to happen, and I know this, I went through this, this is my experience back in 2017, 2018, a lot of people come in and they buy the top. And when people buy the top, they become much more sensitive to price because they've bought at a high price. And generally, with the end of a bull, not only do you have the most euphoric uptrend and everyone's excited and you can't lose, lots of people buy there and then it collapses. And suddenly all those people realize, oh no, I am seriously underwater in my holdings. What do I do? So a top heavy market is essentially a zone where you've got lots of supply that is price sensitive, aka above our current price, that was in a profit just a handful of weeks ago, but is now no longer. So at 31K, right, we had over 75% of the supply in profit. This is what we're looking at here, the percent of supply that's in profit. Now we've increased from the doom zone back here under 50% when FTX blew up, and we've gradually been getting more and more people in profit. At 31,000, right, there's only 25% of the supply that wasn't in profit. Well, what we've seen here is that we've actually fallen 12% of the supply. From memory, it's about 2.6, I think, million BTC has suddenly found itself. It was in profit last Monday. It is now in loss today. So we've seen a major shift in the amount of supply that was previously in the green that is now in the red. Now, another thing to note, just to indicate this top heaviness, the low that we printed back here. Note, here's our price. We have a higher price than we did back here, but the supply in profit is a lower low. That means that even though price is higher, there's a lot more supply that was transitioned to new hands up at these higher levels, right? So for those who are really in there doing some kind of, analytical models and really breaking down this kind of this behavior, you can start to look at how much price has to move to drive more and more supply into the red or into the green, because the exact same principles apply. Here's our bottom at FTX. We traded sideways and did almost nothing, barely grinding higher. And look how quickly supply and profit started to climb. That is telling us that lots of supply has a cost basis lower. It only has to be 1 cent below and it's suddenly in profit. So these rates of change, right? When we start seeing these rates of change in supply and profit or loss, that is telling us something about the top heaviness of the market. And we cover this in the with the URPD chart. So now that we've established that there was a futures flush out, options were obviously mispriced, but what we really do have is a bit of a top heavy market in the spot space. So the next step is, how did investors react to this particular event? Well, the long-term holders did pretty much nothing. So their supply, long-term holder supply, is literally at all-time high as we speak. And what this chart here is looking at the percentage of the long-term holder supply that is being sent to exchanges, right? So we're specifically looking at long-term holders being sent to exchanges. Now, these red bars, we've just put an arbitrary number here, but you can see here it generally highlights fairly high volatility style events. These are panic events. These are profit-taking events. Basically, we're looking at when do the long-term holders really start to spend for whatever reason. There's basically nothing. So not only is long-term holder supply pretty much at all-time high, but they almost didn't even react, right? They are the hodler cohort. In many ways, they're kind of just assumed to be there, and they generally fire back up, at least historically speaking, when we break the previous all-time high. As we break the 20,000 all-time high here in 2020, look at their selling. Suddenly starts picking up. They're going to be most likely, if I was to kind of, guesstimate, I'd say they're going to be pretty flatline until we get up towards that all-time high, and they'll just sit tight. So in many ways, the short-term holders are likely more fruitful for our analysis. Now, this chart is the short-term holder supply. In the orange here, you can see this is our short-term holder supply, and what I've overlaid is the short-term holder supply in loss. Now, this is to really help demonstrate what I mean when I talk about a top-heavy market. So let's look at our 2017 bull run, right? All the way from the bottom, as we keep rallying up and up, every correction, some of these short-term holders, remember short-term holders are chasing the price, they're the most recent buyers. Every correction, some of them go into a loss, but there's still a pretty large chunk of them that are in the profit, right? People who bought over here, they're not really selling on this correction. They're also not selling on this one. So you get these spikes, but then we get to the bull market top in 2017. And look, this is just a different profile. The losses basically fill the entirety of the short-term holder supply. Pretty much everybody, right? This tiny little gap up the top here is still in profit. 2013, tiny little amount in profit. Almost everyone is in a loss. 2019, right? Here's 2019 as well. Same. These events where you get these just an explosion higher, this is the top heavy market we're talking about. For those of you who survived the last cycle, this first top that we had up here in April, this is when Coinbase did their direct listing, April and May. Look at the explosion of short-term holder in loss. This is essential. This is kind of the best visual tool that I've got so far to really describe and just visually observe a top-heavy market. Now, it's a little bit hard to see just because of our zoom, but the red, right, we're talking about 300,000 BTC by short-term holders in profit, and the remaining 2.3 million. 88.3% of all short-term holder coins are now underwater. This is essentially getting into that top-heavy market. So we have that sensitivity. We're now below their cost basis, and we start putting all of these things together, and you can see how the spot market corresponds with the futures market, corresponds with the mispricing of volatility and the options. It was just a beautiful, perfect storm. And it was one of these events where, Bitcoin was either no longer volatile or it was bound to become volatile again. And the market just simply wasn't positioned for it. And downside just happened to be the point of maximum pain. Now, I might leave this one. I think this one's where we really want to close out. So this particular tool is something that we've been developing and building up. It's a bit experimental, so I certainly put it forward. This one is only going to be available for our professional and institutional members. I certainly do, if you kind of get in there and start analyzing this particular model, any feedback is, of course, most welcome. What we're looking at here, we're trying to capture these inflection points. This point where lots and lots of traders suddenly, who were in profit yesterday, suddenly are no longer in profit. Now, this is what we call a momentum signal. So when we talk about momentum, often we're dividing whatever the metric is. The Puell multiple is actually the perfect example of this. It is in fact the original momentum signal. It takes minor revenue and divides it by its 1 year moving average. Why? Well, because comparing the minor revenue to a zero bound is okay. I mean, does it really matter if it moves around relative to zero? For a miner, what really matters is how much did it move around compared to the last year, my baseline, what I'm kind of making my economic calculations on. So the yearly moving average, or whatever we end up using, but the yearly often tends to work, is a really nice tool because it's going to move with the price and it'll help you spot big deviations relative to that. I mean, it's not 4 years, it's not a really long term, which is very slow. 1 year is enough that it's within recent history. It's going to have some kind of relevance to the market structure. Now, the other one, that's the first concept, the concept of momentum. The second one is the realized profit to loss ratio. Now, profit and loss in a bull market, the only way, particularly for short-term holders, which we're looking at here, the only way to realize a loss, particularly when we're in price discovery at all-time high, is to literally buy the local top. So a couple of people buy the local top and then they sell the local bottom. You get your losses peak. So profits dominate in a bull market, except when suddenly lots and lots of people go into a loss. Those inflection points, the profit-loss ratio, will suddenly rapidly move into a loss dominance. And that is what this metric is trying to look at. It's looking at those, and it works in the other direction too. When we're in a loss-dominant regime and we get this inflection from most of the coins are in a loss, let's go back up to our supply and profit chart, most of the coins are in a loss, until price goes 1 cent above. So it's just been losses, red, red, red. Suddenly it's green. All these coins that were previously transacting at a loss, price just gets 1 cent above and they all transition. It's this very, very quick maneuver. And it's a signal of seller exhaustion in both directions, right? You get some kind of a transitional period. So that is essentially what this metric is doing. We're taking our short-term holder cohort, and we have one of these for long-term holders and the total market and entity adjusted. There is a dashboard that you'll find inside the Onchain newsletter. I'll also put a link in the description below to this. So what we're looking for is, when do we get that inflection point when profit suddenly takes over at a bottom, or when loss suddenly takes over because it's a top-heavy market near some kind of local peak? Now, we visualize in two different methods. The first one is kind of just the sheer magnitude of how much the losses have suddenly spiked. And you can see that this thing really accelerates very, very early in the trend. You can see that this thing essentially turned around very soon after we hit our 2017 peak. And it also turned around before we had our May sell-off. In fact, this thing here actually went loss dominant at the Coinbase IPO because lots and lots of people got trapped at that higher level. And suddenly all the profits at all-time high just become losses. And you get this acceleration to the downside. This will also work in terms of divergences. Profit divergences, right? We're getting higher and higher highs, but less and less profit dominance. We're seeing that there's less supply required to make weaker and weaker highs. It's a bit of a bearish divergence. We can see here at the bottom in 2018, the losses were getting less and less dramatic until we finally got that inversion, right? Very, very early in the piece. So we're looking for these kind of transition points. So as I said, this trace here is looking at in terms of a magnitude, how much has the profit loss in kind of that dynamic sense changed relative to its 1 year moving average. And we also have a dominance of all of the profit and loss that's going on. Which one is more dominant, right? So there's a lot in there. But as I said, it's one of these kind of interesting models that's trying to track this very specific phenomena of when do we get a potential regime shift. So to close out, I want to zoom in and look at what we're currently looking at. And the first one is that we obviously get, we're purely looking at when it's in profit and we're going to go into a loss-making regime. You can see that we had this kind of decay of profit in 2019. And then as we started to sell off, we moved into a loss-dominant regime, right? So it started to tell us that something wasn't quite right. We had the exact same divergence in the 2021 cycle. And then this thing here went red, just following the Coinbase direct listing. And then we got this enormous, this is still just a major sell-off that in my view started the bear market. Now we have had a decay of profits throughout 2023. And as you can see, we have the first fledgling downtrend. And in fact, on our dominance chart, we're now pretty much at the floor. Now, it's important to note that this can flick over to the downside in several instances. And typically speaking, much the same way that you'll often see me look at the MVRV ratio, particularly the short-term holder one. In a bullish trend and a robust uptrend, we really should find support. Short-term holders should step in and buy their cost basis at those levels, and we can get this reversion back to the upside, right? Same here in the August-September sell-off that we had here. We did have a very short reversion, so it can give you these kind of, these are moments, these kind of scares to the downside. But generally speaking, if it sticks the landing and stays there, you can see it generally sticks the landing and stays there, and obviously works to the upside too. You get this burst of profit taking, and that's actually enough to send us back down into back down to Hades, as some would say. So anyway, it's a very interesting model. As I said, I will leave a link to a description. There are 4 different variants of this. They are all building off the concept of realized profit and loss. These are some of the most interesting tools, certainly that I spend time analyzing. And because at the end of the day, why is this important? Investors generally respond to profit and loss. It's what brings a lot of people into markets. It's what keeps people in markets. And it goes back to that very primal instinct of profit and loss. Fear and greed is what drives markets. So what this is trying to look for is when you get those concentrations and regime shifts, when something has just switched and changed. That's really what this is trying to do. So please do let me know if you have any comments or feedback. As I said, it is an experimental tool, and we're still kind of testing it and playing around with some of the dynamics. So certainly anybody who's kind of crunching numbers, we'd love to hear from you and see what your thoughts are. So thanks everyone for tuning in. Hopefully you found that useful. As always, please do let me know your comments or thoughts below. Do keep an ear out for our announcement on Thursday. As I said, this is a fairly substantial piece of work. We're really looking forward to getting feedback on it. It is a very interesting and kind of, it's a new way to think about on-chain analytics and some new economic models, new ways to conceptualize the Bitcoin economy. And I really do look forward to many of the ideas and analyst concepts that come off the back of it. So do keep your ear out for Thursday, and I will see you in the next one. Cheers.